So with regard to, in general, how do we find companies? It's usually through referrals. If I think about our portfolio, it's because a transaction advisor told us about this particular company. It's because a lawyer told us about this particular company. It's because we've kind of known the company for a couple of years, and now there's a connection in terms of them looking for capital when we have capital available. So please, continue to build your network, build relationships with investors. The answer may be, please don't treat it as a transaction, the relationship. It can take literally years to build that rapport so that each party is comfortable moving forward with an equity investment. I think on the ag tech side, we found it particularly tricky because here's usually what happens. We're usually talking to probably 4 or 5 or 6 or 7 different ag tech companies, and they all want to do the same thing, right? They all want to collect farmer data. They all want to build a credit scoring model. They all want to use, I can't tell you how many times I hear artificial intelligence and how many times I hear all the other buzzwords in the data analytics space. In truth, they don't have enough data points in order to be able to build an algorithm that is reliable from a predictability standpoint. And so what we struggle with as investors is finding those companies that either are on the approaching having enough data or have a plan to have enough data upon which they can actually build financial products or solutions or things like that. I think that's where we're often stuck when we are analyzing ag tech companies to figure out, does this really make sense? Does this have the ability to scale? Does it have the ability to de-risk investment, give farmers early warning system, build a credible financial product off of? In terms of diamonds in the rough, what are the nuggets that we're starting to pay more attention to? It really is engagement. Like we had the presentation around platforms was really helpful, but what we always struggle with, and it was one line here that I do think deserves a little bit more attention, is just around utilization. Someone will be able to get 20,000 farmers on their platform, but when you double click on it, you realize only 200 of those farmers are actually transacting on the platform, right? And that's a good place to start. But it's not enough of a revenue generator for us to see how this particular model is going to go the distance. And so what we're looking for is, like, little by little, year over year, is your penetration rate? Do you have a higher percentage of farmers engaging on your platform or engaging with your ag tech solution over time? That's what we're looking for, kind of signals in the noise that you're really onto something. We're looking for companies that have a very credible feedback loop to their farmers. If you are just kind of putting a service out there and kind of having a spray and pray approach, if you will, with your product, that's not going to work because you're going to miss the nuances in, oh, actually, farmers prefer to get this information at farmer days, or female farmers actually prefer to do this in the lending groups that they're already a part of. There are all these nuances in working with farmers, even when you're thinking about digital solutions, that we rely on our companies to be able to pick up on these nuances and have the feedback loops. If we're not seeing that, if we're not hearing that, we just are really hesitant in terms of kind of being convinced and therefore convincing other people, because just so you know, the way that it works is I can be convinced, but then I have to convince a committee of people that you guys as the entrepreneurs know what you're doing and are worth backing. So there's a lot of different layers to the whole investing process. But at the end of the day, we're looking for indications that in the ag tech space you have really figured out how to get more data points and how to generate revenue, which means you have to have a significant amount of scale, because in most cases, ag tech, you're trading on margins, right? You're getting a few shillings here, a few naira there on each transaction. So you need a lot of transactions and a lot of people transacting in order to make that work.
I think it's really the same from a donor perspective, especially if you look into like venture philanthropy space, where it's about entrepreneurial models. Everybody needs to prove that the organizations they give money to actually reach the people that all of this is about, right? I mean, we're sitting in this fancy hotel ballroom thingy, but we're talking about smallholders out there. So this is what matters, and not like who you can convince. I mean, who you can convince, of course, to give you money, but then what you do with the money, right? So at the end of the day, it's all about reaching those people that need the service, that you believe is the right service for them, right? Is there a trade-off between being profitable, like you just mentioned, and the actual societal goal that you have to help the community? And if yes, what does it look like?
Okay, so before I answer that question, it's so funny. we're currently in diligence with AgriFin West Africa and talking to our biggest team, and they asked us for a bunch of data, and now we know why. So it's like my team is. I think from an investment standpoint, talking to certain people, like maybe acumen understands impact very well and how that can end up translating into profitability. But I realized that in all our time talking to investors while we're raising now, we actually had to completely drop our impact side and put it under FAQs, right? And it's simply because the moment you even start to like raise impact, it starts to scare investors in this space. And the challenge you face is that you give one investor a deck, they share it to other investors, so you can't have 10 different decks for different people, so you need to figure out how to balance that. So there is definitely a bit of a trade-off there. And I think for the kind of main VC people, one thing we're realizing is that I've had the opportunity to kind of look behind the hood in some of the things they're investing in. And they're not scaling in some cases. In some cases, they're not even profitable. However, there's this like vision, a dream of like IPO, exit, and they hand over $50 million to people, right? But you'll find that there are some smaller ag techs that actually maybe even doing better than some of these bigger people that are getting money, but because somehow they've been put under the impact space, the way they're perceived, or immediately the information that investors get about them, like result in them either being valued less or perceived as risky. And okay, so I'll add one more thing. There's I think Matt was saying the agriculture market is very fragmented. So automatically, even before you talk to an investor, they think that your platform is riskier. And I literally watch how long people spend on my deck. It's always less than a minute, right? And that's how long it takes for them to decide whether they will invest in you or not. And because they already have that preconceived notion that agriculture is risky, the moment they get into your deck and they see agriculture, they disappear. Right? So they're all
well, is that the reason why there's $170 billion missing in investment in AgTech?
The perception of riskiness. Yeah, again, it's a difficult question to reflect on in like a minute or however much time I have. I'd say, building on what I said before, there's not a lot of data, so there's not a lot of things to base your decisions on, so perceptions become important. Yes, agriculture is risky. You have things like weather risks that you maybe don't have in other sectors. You have, like Matt said, a super capital intensive industry where, yeah, you can digitize everything, but if there's no trucks, or if the roads don't work, or a bridge breaks down, it doesn't matter how good your platform is. So yeah, there's all these things which perhaps are bigger risks than elsewhere. Something that I've observed in our data. So just to give a little bit of background, we've studied 100 models that deliver goods and services to farmers over 8 years, across different value chains, across different geographies, across different types of companies. And what we've noticed is that for part of the market, a lot of the perceptions indeed are true. So especially when you look at service delivery to smallholder farmers in globally traded cash crops, for example, yeah, like almost none of them break even. In fact, that's really inaccurate what I said. Almost none of them even generate $1 in revenue from the farmers. They provide everything almost for free, or they're very heavily subsidized. Why is that? Well, I think that's because it's a very long story, but in a nutshell, I think it's because many of these programs evolved out of a legacy of development. Over time, they took over the functions that governments or development agencies were doing, and the primary goal of that was achieving impact at the farm level. So it never was really that important to break even. I think the perceptions that we've inherited from that development are still shaping a lot of the thinking on the sector. Like, the sector is inherently super risky. No, I don't think that's true, and I think it might be shaped by some of these experiences. To say one last thing, and then I'll give away the microphone again. We've also noticed many instances of service delivery to smallholder farmers breaking even and even making a profit. And you know what? this often happens in the types of value chains where you don't expect it. Loose value chains, where the company who's sourcing from the farmers, they might train the farmer or give them inputs, but don't really know if the farmer is going to sell to them at the end of the season, because there's many different buyers. Value chains in which there is no consumer in another continent willing to pay a premium for sustainable production. Companies that don't have a headquarters in Europe and therefore slightly easier access to donors and impact investors. In these value chains where you wouldn't expect it, we see many models that are investing more in farmers and recovering more of their cost in farmers. So again, I think the issue is there's not enough visibility also of the success stories that is feeding these quite pervasive perceptions.
Well, thank you. I think that's a good segue into opening for the Q&A, but maybe as a closing word, I'd like to ask you, Anna, if that's also your perception from DigiCow's perspective as an investee, how the journey was, if you would agree with what Will just said, and then we'll close it up. And I see a lot of question marks on people's faces. That's a good sign.
I would like to say that for us, as I had said earlier, it's not an easy journey getting people to invest in our business. But gradually, and with forums like this, we get an opportunity to network with potential investors. Also, slowly we are learning on how to best identify investors that are well aligned with our goals and vision.
How do you think about these types of investments and grants?
The problem, I must admit, is this social impact is a quite amorph definition and a quite amorph thing. And as a matter of fact, if you look in investment, it should be, well, if you really want to mean it right, it should be actually be in the P&L of an organization, just like your normal funds. The problem there is that the measurement is so complicated. And as a partner in an ARTIF, which is an investment fund, it's not a foundation. We actually tested something like investments in Ghana, where we said basically, well, we're going to reduce your interest by 3 percentage points if you reach enough smallholder and improve their livelihood. Well, it didn't work out so good, because the measurement of these things are so complicated, and I think there is a lot of room for improvement. And if we really want to have impact as investors or as foundations, we really have to work on this and bring it to an even level, like the balance sheet.
That's a wonderful and I think somewhat an answer that I somewhat predicted a bit, which means it provides a lovely segue to kind of addressing some of the definitional questions in this space, right? So I think everyone can acknowledge that if you had to stand up and make 2 sentences defining what climate finance is, I doubt anyone here could do it very well unless you said something so broadly generic that it could have no indicators to measure. And I know, because I tried to do this, and I've tried to do this in front of audiences, and I just stumbled all over myself. I think part of the issue here is that climate finance has been focused on balance sheets, and some of that has, and we'll get to this in a bit more detail later, has gone toward carbon credits and finding means of very quick ways to have that sort of funding ultimately show up on balance sheets. And as a result, some of the more complex topics like adaptation, where we still have counterfactuals to understand, but many different types of indicators that could kind of be representative of the improvements to smallholders in our space. So Rebecca had mentioned many things, including things like insurance, that 60 decibels has been measuring for them. But I wanted to come back to Albert again and to ask first about, how has Rabo been thinking about these types of indicators? Are there emerging trends in things that are kind of seem important? Because I think while no one can provide these definitions very well, they're already being implemented in some cases, right? We're making decisions about companies and projects based on some of them. So going to kind of kick it to you to frame it for us, how you're thinking about those measurements, kind of both, either broadly or definitively, if you would offer those.
Yeah. So impact measurement for AgTech and fintechs. Yeah. Yeah, I think especially AgFintechs, because they're digital by nature, provide a lot of opportunities for impact measurement. And I also see that underexplored or underutilized. And that's partly because they're all struggling, or many of them are struggling to get their data quality in the first place in place. But there's a lot of, let's say, new types of indicators, ranging from traditional data to remote sensing data that can be used to measure not impact, because we all know that, strictly speaking, impact can't be measured unless you do randomized control trials. But a lot of proxies are available, and that's what we also started to discover when we established the remote sensing for the carbon sequestration measurement. What else you can measure if you have that? And maybe we'll come to that later, but you can of course detect if farmers have irrigated. You can measure biodiversity. Can measure crop suitability, and that's just an example. There's a lot of other data available if you digitize payment data, transaction data in the ERP systems. But it's still underexplored, underutilized, I would say, and more is possible.
Until we were raising your mic to prepare for either rebuttal or addition.
I'd say difference in the sense that if you're investing in, let's say, the last 2 miles in early stage companies, they're pivoting maybe 3 times before they get to Series A. So we have to be honest about when we say impacted measurement. We have to be fair to the entrepreneurs and the people that they're serving, which we pretend or want to say is where we want the impact. I'm sorry, I'm cynical here sometimes. I apologize. So I'm just saying that we have to be, open about what we're really talking, until we know we're really fair to those entrepreneurs and the people that solution solutions. So I think, looking at it from the types of investors we're looking at, you mentioned climate finance and adaptation. We talked about a little bit before, adaptation versus mitigation. I think anyone who wants to make sure to solve for people and the planet is going to have to think about adaptation. And at that point, there's some complexities in the last 2 miles when you're looking at carbon sequestration, et cetera, because even if the last mile platform is figuring these things out, there isn't enough slice from the carbon credit revenue for that smallholder farmer. So you actually have to figure out enough of a stack to actually figure out what is going to change and keep behavior changing.